the next one is abolition of direct credit programs. So the directed credit programs, according to the Narasimha Committee report, be abolished gradually, and priorities that can be redefined. Coming to the free determination of interest rates. So the rate of interest should be determined freely without the intervention of the Reserve Bank of India. And the effort should be made in order to achieve a minimum 4% capital adequacy ratio in relation to risk-weighted assets. There was a certain time period that was given, like for adoption of uniform accounting practices, right? All follow similar accounting practices, particularly in regard to income recognition and provision against doubtful debts. The committee also recommended imparting for transparency to bank balance sheets, full disclosures in them. Right? And another important recommendation was establishment of special tribunals. So the special tribunals should be set up in order to speed up the process of recovery of loans. The asset reconstruction fund that I just told you. So the asset reconstruction fund should be established in order to take over from banks and financial institutions a part of their bad and doubtful debts at a account. So it was the responsibility of the asset reconstruction fund to transfer whatever bad and doubtful debt banks have at a particular discount rate. Right? Then reconstitution of the banking system. So the entire banking system be reconstructed or restructured in such a way that there are only 3 or 4 large banks which could operate like at an international level. That so they should grow to such an extent that they can compete or they can match up with the best of international banks. And there should be around 8 to 10 national banks which have network of branches throughout the country, and it's responsibility of these banks to engage in universal banking. And there should also be local whose operations should generally be confined to specific region, and like the rural banks, right? The regional rural banks, RRBs. So these regional rural banks, their operation. Is my voice audible? Are you able to hear me? I don't know why my audio is getting muted again and again. I don't know why it is happening like that. Okay. So there should be these regional rural banks whose operation would be confined to rural areas, and whose primary purpose would be to provide finance whose primary purpose would be to finance agriculture and allied activities. So it also recommended setting up of one or more rural banking subsidiary by every sector bank, so that all its rural branches are taken over by this rural banking subsidiary. So the purpose behind it was, see, the banking requirements of people in urban areas and rural areas are very, very different. So if banks really want to cater to customers in the rural area, they will have to design specific programs, specific products that suit the requirements of those people in the rural area. Right. And one more recommendation was the committee recommended abolition of branch licensing, and the matter of opening or close of branches, that should be left to the commercial judgment of the individual banks. Whatever that particular bank felt correct, it should be allowed to do that. And similarly, the committee also made a recommendation about foreign banking, right? So the committee recommended for liberalizing the policy with regard to allowing foreign banks to open offices in India as branches or as subsidiaries of other banks. And these foreign operations in Indian banks also should be rationalized. So, and then um, and the committee also made some recommendations about the financial institutions, right? So it said that transferring of direct lending function of IDBI should be done to a separate institution, while retaining IDBI as the apex and as an apex institution as far as the refinancing role is concerned. And it also said that Reserve Bank of India should set up a new agency to supervise financial institutions such as merchant banks, mutual funds, leasing companies, venture capital companies, and factor companies. And then capital market should be liberalized, right? This would ensure that more participants enter the capital market, which in turn would strengthen the financial system of the country. Now, coming to the recommendations of the second report, the Narasimhan Committee Report 2. This report was submitted in 1998. The first one was submitted in 91, and this was submitted in 98. So the committee considered, the committee envisaged a very strong banking system in India. So they considered the stronger banking system in the context of current account conversion, CAC. So it thought that Indian banks must be capable of handling relating to domestic liquidity, it recommended a couple of strong banks which would have a multiplier effect on the industry. So, and another thing was narrow banks. See, those days many public sector banks were facing the problem of non-performing assets. So some of them had NPAs that were as high as 20% of their total asset base. So for successful rehabilitation of these banks, it recommended narrow banking concept wherein weak banks were allowed to place their funds only in a short-term and risk-free asset, whereas the relatively stronger banks, right, they could explore a little more, right? That was one thing. Then another recommendation was about capital adequacy ratio. So in order to improve the inherent strength of the Indian banking system, what this committee recommended was, it recommended that government should raise the prescribed capital adequacy norms. And increasing this capital adequacy norm, that would further improve the absorption capacity. So currently, presently the capital adequacy ratio for Indian banks is at 9%, right? Then coming to bank ownership. So as it had, earlier mentioned, the freedom for banks in its working and bank autonomy was very, very important. It also felt that the government control over the banks in the form of management and ownership and bank autonomy, it does not go hand in hand. Therefore, it recommended a review of all the functions of all the boards, all these boards that were overlooking the operations of these banks, and enabled them to adopt a more professional corporate strategy. Then about banking laws. This committee considered that there was an urgent need to review and even amend some main laws governing the Indian banking industry, like the RBI Act, the Banking Regulation Act, SBI Act, and all those things. So what this upgradation would do is, this upgradation would bring the banking sector in line with the present needs of the banking sector in India. So since the pre-independence and immediately after independence, the same systems were being followed. So the committee felt that no, there is an urgent need in order to upgrade and review these laws, so they were more in tune with the present time. So apart from these major recommendations, the committee also recommended for a faster computerization, technological upgradation, and if computerization was to be done, one major thing that was needed was staff had to be trained, because the staff had earlier not been exposed to any form of computerization, and delinking of banks from political influence, or depoliticizing of banks, professionalism in banks, and the bank recruitment also, right? Bank recruitment also needs to be done in a much more systematic manner, right? So that was also one thing that was decided. That was also one thing that was, suggested. Next, coming to the next topic, understanding the financial market in India. So, the financial market in India can be understood as a place where financial products and services are bought and sold on a regular basis. So, it is not exactly a place or a physical place, but it is a mechanism which ensures that the buyers and the sellers come together, can interact and buy and sell on a regular basis. So this financial market, it deals in the purchase and sale of different kinds of investments, different kinds of financial services, loans, etc. So financial market in India can be divided into the money market and the capital market. So more if you have to simplify it and say, we can say that financial market is any system where trading of security takes place, that is buying and selling of securities takes place. So forex markets, bond markets, stock, money, all of them comes under financial markets. And again, see, the economic development of the country is very much based on the financial markets. So if the markets fail, the financial markets of a country fail, it could result in recession in the economy. It could lead to large-term unemployment also. So therefore, like any other market, even the financial market involves trading. That is buying and selling. Buying and selling of what? Buying and selling of financial products and services. So therefore, the financial markets basically deal with sale and purchase of several types of investments, financial services, loans, etc. So the demand and supply of financial instruments, it is very dynamic because the financial instruments determine their prices, right? The price is determined by the relative demand and supply for that particular instrument. For example, if you look at share prices of a particular company increasing on a particular day, so in a from one perspective, you can say the number of people who want to buy shares of that particular company are more than the number of people who want to sell. Or similarly, if a price of a particular share price of a particular company is falling, we can say that the number of people who want to sell that particular share is more than the number of people who are willing to buy. So the sale is more than the purchase, right? So that is what you mean by price determination, right? So let us look at the structure of financial market in India. So the financial market in India can broadly be distributed into two components, that is the money market and the capital market. So first, let us look at the money market. So this money market acts as a marketplace or a mechanism or a system for short-term borrowing and lending. So on a larger level, it involves large volume transactions between traders and institutions. And at the retail level, the money market involves mutual funds that are bought by individual investors like general public like you and me, and the accounts that are opened by bank customers. So the assets traded in the money market, they are risk-free and they are highly liquid. And since the maturity period is less, the risk of volatility is low and the returns are low as well. So the common example of instruments traded in the money market are treasury bills, commercial papers, certificate of deposits, bankers' acceptance. These are some of the common instruments that are traded in the money market, right? So I told you the financial market is divided into two components, money market and capital market. I discussed about capital market. Now, capital market again is divided into two components, two markets. What are those two markets? Primary markets and secondary markets, right? Primary market and secondary market. We said money market deal with short-term securities. Whereas capital markets deal with long-term securities. So these securities have a maturity period of more than a year and they are traded in the capital market, right? And the market trades in both this capital market, it trades in both debt as well as equity-oriented securities. So who are the participants in the capital market? The participants in the capital market are FIIs. FIIs stand for foreign institutional investors, financial institutions, individuals, general public like you and me, NRIs, HNIs, high net worth individuals, right? So all of them are a part of the capital market, right? Capital market again, like I told you, is divided into two components, primary market and the secondary market, right? What is primary market? Primary market is also known as new issue market. Secondary market is known as the after issue market. So what exactly is the difference between this primary and secondary market? In the primary market, a company sells its share directly to the investors. So the investors purchase shares directly from the company. That is the primary market or the new issue market. What is the secondary market? In the secondary market, the company is no longer in the picture, but shares are now bought and sold between the other investors. The company has already sold it. Now the company is not in the picture. So for example, XYZ company is there. XYZ company has issued its shares to the general public. So I have bought 100 shares from XYZ company. So that is the primary market because I have directly bought it from the company. So after some time I need money. Now I need to sell these shares. So what I do is I put up these shares for sale on the market. So on any given day, whatever shares we have, we can sell them. So some other person, an unknown person to me, would buy those shares. Now this is called in the secondary market. So the transfer is happening between not between company and the investor, but between other investors. Right. So this is the primary difference between the primary market and the secondary market. What are the usual functions that you see in primary market? Underwriting. Underwriting is a major function. Origination, distribution. These are all some of the important functions of the primary market. Whereas some of the important functions of the secondary market are, buying and selling of securities, between those investors without any involvement of the issuing company. The issuing company is nowhere in the picture. So what is happening in the primary market? Shares or stocks are being issued for the first time. And in the secondary market, these shares and stocks that were issued for the first time are now being traded. Again and again, they are being bought and sold. So I bought from XYZ company, then I sold it to A. A must have, after some time, A sells it to B, B sells it to C, C sells it to D. So that keeps on repeating in the secondary market. And the major financial intermediaries that you see in the primary markets are the investment banks. Whereas in the secondary market, the major financial intermediaries are the brokers, the stock brokers. You have these online platforms these days, Zerodha, Upstocks, and all that. So what they do is they do this stock broking function. So I have shares, I want to sell these shares, but I don't know who will purchase my shares. So when I log onto a platform like Zerodha or Upstocks, they would link me, a person who wants to sell shares, to another person who wants to buy those shares. So stockbrokers are the important financial intermediaries as far as the secondary market is concerned, right? And one more difference between primary markets and secondary markets is in the primary market, prices are usually fixed. So prices could be fixed at face value or par value, or price could be fixed at the par value plus some premium amount. So prices are fixed. Whereas what happens in the secondary market, the prices keeps changing depending on the supply and demand of shares. So every day prices could change, not just every day. In a day also, as time passes by, if you keep tracking or if you keep monitoring the price of a particular share, every minute, every second, the price keeps changing. And the price keeps changing because of the changes in the demand and supply for that particular stock. So IPOs, they call it as IPO, initial public offering. Initial public offering means a company is for the first time offering its share to the general public. So in IPOs, bonus shares, right share issues, private placement, preferential allotment, all of them you see in primary markets. Right? But is stock market the only type of financial market in India? No. There are, apart from these, what we have discussed now, there are other types of financial markets also, right? So what are these other types of financial markets? The commodity markets are there, right? So what do these commodity markets deal with? Commodity market deal with trading of commodities like, pulses, gold, metals, silver, oil, grains, all of these are traded in the commodity market. Then derivatives market. Derivatives market, futures and options, they are traded here. Right? Futures and options are traded. So the market is called as derivative market. Then there is something called as OTC market, which the over-the-counter market. This market, it deals with companies that are usually small and that can be traded cheaply without any regulations. But now you do not have this in India. Earlier, it used to be there, OTC, over-the-counter exchange of India, but now it is not there. Right? Then the foreign exchange market. The foreign exchange market, it deals with trading of currencies of different companies, and this is considered as the most liquid financial market, as currencies can be sold and purchased very, very easily. And how do the traders benefit from all this? See, the fluctuating rate of currencies, that is what benefits the traders, right? So the traders who are eager to derive profits by selling at a higher rate and buying at a lower rate. So that is how the traders benefit in the foreign exchange market. Then you have the bond market, right? So what bond market does is, bond market facilitates trading of government and corporate bonds that are offered by companies, or that are also offered by the government in order to raise capital. And these bonds are debt instruments, right? They are debt instruments and they have a fixed rate of return. They also have a specific tenure. There is a fixed time for it. Therefore, see, the advantage of bond market is, for example, when I'm buying a share of XYZ company for 100 rupees, this price of 100 rupees can become 1,000 rupees, or it could become 10 rupees also. That unpredictability, that risk is always there. But whereas in bond markets, since it is a debt instrument, it has a fixed rate of return. So if I purchase a bond instrument for 100 rupees, I know how much of return I would get, whether it is 103 rupees or 104 or 105 rupees or whatever it is. So that rate of return that I would get is fixed, and the tenure is also specific. I can buy shares of company today, I can sell it tomorrow. Whenever I want, I can buy and sell it. But that is not so with bond market. So when it comes to liquidity, bond markets are more illiquid when compared to the share market. Then apart from this, you have the banking market. So this banking market, it consists of banks, it consists of non-banking financial entities that provide various kinds of banking services, like, collection of deposits, offering loans, and all these things, right? Coming to the functions of financial markets. What do financial markets do? What are the various services that they offer? So the first one is, financial markets, they offer a platform for the buyers and sellers for trading different types of financial products. These financial markets, they help determine the price of the financial instruments that are traded in it. So the price is determined through the demand and supply of the instruments. And these financial markets, they help investors by providing liquidity at the time of selling off the investments for funds. So whenever I need money, as an investor, I should be getting back my money. That is what you mean by liquidity, right? And then it also facilitates buyers to acquire funds when they need financial assistance. See, it is helping investors as well as it is helping the borrowers. Whenever the investor needs money, the investor is able to liquidate, his assets, and is able to get his money. And whenever the borrowers need money, it is also facilitating that the deserving borrowers have access to money. So the financial market in India, it influences the economic growth of the country. It also helps mobilize funds from investors to borrowers. Right? Now, who regulates these financial markets? Who are the regulators of the financial markets? Right? By learning about the financial markets in India, it is very important to understand about uh, the regulation that happens and who its regulators are. So the regulators of financial markets in India, they have a special status as far as the Indian economy is concerned, right? So these regulators, they operate in the financial market so that the participants of the market abide by the laws and regulations of trading. And similarly, these regulators ensure that there is a fair trade in the market and the investors' interests are protected, right? Investors' interests are very well protected. So some of the prominent regulators of financial institutions in India are RBI, SEBI, and IRDA. RBI is Reserve Bank of India. So Reserve Bank of India acts as a chief and prominent regulatory authority to the banks and even to the non-banking financial institutions also. It is called as the Central Bank of India, right? It is called as the Central Bank of India, which is responsible for formulating the monetary policies, foreign exchange policies, credit policies, etc. So all the banks and non-financial institutions in India, they are required to follow the rules and guidelines that are set by the Reserve Bank of India in order to stay operational in the market, right? So that is the role of RBI. Next, coming to SEBI. What does SEBI stand for? SEBI stands for Securities and Exchange Board of India. So SEBI is the prime regulator of the capital market. What does it mean? It means that it is responsible for regulating both the primary as well as the secondary capital markets. Primary markets as well as the secondary capital market. So all the trading and all the transactions that take place in the capital market, they are governed and they are regulated by the rules and the regulations that are laid down by SEBI, Securities Exchange Board of India. Coming to the third one, again a very important regulatory body, IRDA, the Insurance Regulatory and Development Authority. Now, this IRDA acts as a chief governor of the insurance companies and their intermediaries. IRDA is entrusted with the responsibility of regulating the insurance market, comprising both life insurance as well as general insurance markets in India. See, if people are buying insurance products today, with the confidence that tomorrow in case of need they will get the money, that is only because IRDA is doing its job properly. IRDA is regulating the whole insurance sector. So see, when will I buy a life insurance policy? I will buy a life insurance policy only if I'm assured, if I'm 100% assured that tomorrow something happens to me, my family would definitely get the sum assured. If that 100% assurance or guarantee is not there, then no person would buy a life insurance policy. And where do I get that assurance, that guarantee? IRDA is providing me that assurance, that guarantee that, come what may, we will make sure that, insurance companies are following all the rules and regulations. Insurance companies are honoring all the commitments that they are making, right? So that is about financial markets in India. Next, coming to uh, uh, how can banking sector be made more efficient and more effective? What are the different ways of making banking sector more efficient and effective? So the banking sector, it can become more efficient, it can become more effective by improving the customer service, by adopting the digital technologies and the various automating processes. So, when it comes to improving customer service, what is more important is omni-channel support. That means customers must be provided support with multiple ways to contact the bank, such as phone, email, chat, or even through social media. Also today, today banks are even accessible on social media. Then another way by which you can improve the customer service is by personalizing the experience. So you can address the customer needs during major requirements. During their important life needs, like a customer is buying a house, a customer wants to fund his child's higher education, all these things, right? The next one is proactive outreach. Banks should reach out to customers proactively, and they must offer real-time help. And they should constantly take feedback from customers. They should find out from the customers what their opinion and feedback is. If that constant thing is not there, then it becomes very, very difficult, right? Then talking about embracing digital technologies. So, um, uh, banks should establish a digital culture, like um, uh, everything paperless system should be encouraged. The digital culture should be created with lot of commitment and vision, right? And digital tools should be used to modernize operations. The processes should be optimized, and new revenue streams should be unlocked. So if a customer earlier, if a customer wanted to know his bank balance, he would have to go to the bank, visit the physical branch, and then find out what is the balance in his account. But today, you can, wherever you're sitting, just with using your mobile phone, you can know how much of money is there in your account, right? Then you have to use AI chatbots. Big data analytics should be used, right? This big data analytics, what it does is it analyzes customers' conversion rates, and with the help of this data, marketing campaigns can be created. And most important concern today is cyber security, right? So cyber security should be considerably improved. Uh, robust cyber security features should be implemented. Client information should be protected. Data should be protected in order to prevent any kind of fraud. And cyber security measures should be strengthened, right? Steps should be taken in order to protect against any kind of cyber threats, right? So these are some of the reforms, right? Then reforms in the debt market also, right? Not just in the banking sector, but reforms are needed even in the debt market also. So what are some of the reforms that are needed in the debt market? See, automatic monetization of the fiscal policy was removed. What it allowed is, it allowed the government to borrow funds from the market uh, by selling of its securities. Now, the government interest, borrowings interest happens to be as per the market forces. So, what this has made is, this has made the government more cautious, more wary of the country's fiscal deficit situation. Then the 91-day T-bills or treasury bills were introduced. These bills, they help with the short-term needs of the organizations. And these instruments, they also provided the required liquidity, right? So delivery and payment settlement system was also improved, right? Then looking at the reforms in the foreign exchange market, right? Foreign exchange market, forex market, as the short form of foreign exchange is forex. So it is also known as the forex market. So what India started doing is, India started adopting the market determined exchange rates, and also the current account convertibility, that was also introduced after the Nursing Committee recommendations were came. So in 91, the committee recommendations were put forth, and 93, in India, this current account convertibility was introduced, right? And commercial banks could also participate in the foreign exchange market. What this did is, this greatly helped to bring better international standards even for Indian banks. The currency swap transactions also began with new players in the market. However, these swap transactions still had certain limitations which were being worked upon. Right, the FERA regulations were changed. FEMA came into existence. FEMA replaced FERA. So what this led to higher freedom for India's foreign exchange system. And the exchange traded derivatives, they were allowed to Indian non-residents and foreign investors, right? Uh, so, uh, with reforms in banking sector, with reforms in foreign exchange markets, with reforms in the debt markets, a lot of changes came across. A lot of changes came across in the financial sector. So, what were the changes that were seen? In fact, most of these changes were for the good. So what happened is India became more resilient. India became more stable. So like I told you, the 2002, 2007, 2008 global financial crisis, Indian economy did not get affected because of that. Indian economy did not get affected because of that, only because the Indian financial sector was strong, right? And even the growth rate also improved after these financial sector reforms were introduced. Um, um, and what the introduction of foreign and private banks did was the introduction of foreign and private banks increased the competition, right? So once the competition increased, even the government, the public sector banks, they were forced to perform better, and because of all this, the customer benefited a lot. It was ultimately the customer who gained the benefit out of all this. Then the stock exchanges, they started adopting international standards, which resulted in improvement of the overall performance, right? And these reforms, they improvised economic measures like fiscal imbalance, public debt, budget management, and all of them, right? So, what is the importance of these financial sector reforms? See, financial sector reforms, they cater to the changing needs. They help the financial institutions cater to better living standards and increasing industry demands. The financial sector reforms, they help go through various crises. The economy can handle such times when the financial system is strong or when the financial system is solid. Now these reforms, they bring more competition. It helps in better standards and it induces companies to grow. So these reforms are necessary to provide better credit facilities, and the entire economy is driven by demand and supply, by economic activities, right? So the financial sector reforms, what they also did is they didn't just revamp the financial sector, but they helped in the development of all the sectors, the entire economy as such. So, small businesses, agriculture sector, marginalized sectors of the society, all of them benefited from these particular changes. Okay. And then, one second. Yes. Um, but whatever these challenges were introduced, these reforms they were introduced, there were a lot of challenges inherent in them, right? It wasn't that easy to introduce these reforms. So when the prices in the real economy, they reflect the economic cost more closely, and with greater reliance on the private sector, it becomes very natural. It becomes very important to move from a financial system um, that was more dependent on government to a system where, financial institutions play a very crucial role in allocating resources, right? So this became a major challenge. And then, the importance of incentives and the legal, regulatory, and supervisory framework. This was also very, very important. Okay. Right. So this is about financial sector reforms and financial markets, right? Uh, with that, I would stop today's session. The next session topic would be money market and capital market. So, what are the functions of the money market? The organized and unorganized components of the money market. What are the characteristics of money market? What are the various instruments in the money market? All that would be discussed. Apart from that, what are the functions of capital market? What are the various segments and instruments of the capital market? All these things also would be discussed. So that would be on money markets and capital markets. With that, I would end today's session.